workshops every week, every Wednesday at 1 o'clock, and they're recorded and they are put out on YouTube. So if you miss an episode, you can always catch up on it. And these are really just workshops for you, where we talk legal, financial, and tax planning. And we're just typically answering questions or talking about what's kind of going on in the world. So there's no PowerPoints or anything. There's no sales pitch to get you to take action or anything. It's just, hey, I'm here answering your legal, financial, and tax planning questions. And this is coming from a certified elder law attorney. I think there are 17 of us in my state of Michigan, as well as a certified financial planner. And I think there might be 2 of us with those 2 designations in Michigan, and maybe a handful of us across the nation. So plus I was an adjunct professor, so I taught a lot of this stuff to law school students as well. So if you have questions you want answers to, this is your time to get those questions answered. And I already had some questions submitted ahead of time, so I appreciate that. And I will go ahead and share my screen. And before I do that, I always like to start with a positive focus, something positive that happens or is happening. And my positive focus, twofold, both family related, well, threefold, I guess. My daughter, she got selected to play with the select soccer team. So her team that I coached this year went undefeated and won the league championship. And then they called her up to see if she wanted to play with the select team. So that was a pretty cool opportunity. And then my son, he's just like really taking to swimming. He's in a swim, kind of like a precursor to a swim team. And so while I was taking my daughter to soccer last night, my son had swimming. So it was kind of cool. Just like seeing the kids excel at stuff. And then another positive focus is just all the family stuff we have coming up. Along with my parents who live 4 houses down, we're going to Chicago this weekend to go to the aquarium and science museum. And we have the Detroit Zoo lights event scheduled, and everyone's birthdays is coming up, and Thanksgiving, just a lot of things going on. So all good. So pretty excited about that. And with that, let me go ahead and share my screen. And again, if you do have questions, please put it into the Q&A section, and I'll go ahead and answer those questions as they pop up. And then if something's unclear, feel free to, again, put it in the Q&A, or feel free to also put it in the chat. And with that, let me go ahead and try to share my screen, assuming technology is working with me. Oh, see, I'm at my satellite office right now, so sometimes it's a little sketchy. And awesome, it's not working. Connect. Give me just a second. Perfect. Here's lacrosse. Why isn't it popping up? Technology is great, except for when it doesn't work. And so right now, it doesn't appear to be working. All right, connect the iPhone to iPad when prompted. Let me try this. Oh, there we go. All right. Well, weird way to do it, but we got there. Okay. So our questions. And again, if you do have a question, please put it into the Q&A. So the first question here. This is kind of a follow-up question to last week. While knowing this here, Chris, while knowing the cost of nursing home is instructive, it would be helpful to know the total cost of long-term care. It would help us to understand the true risk. All right, so I've talked about the cost of long-term care, more specifically nursing home care, just because that's kind of the devastating cost of long-term care. But there's a company, and they do long-term care insurance, so take it for what it's worth. but there's a company, and if you go to www.genworth.com, they do a annual long-term care study. And so basically what we find is what I call the elder care journey here. And so what we find is, first of all, you start off living at home independently, and we always figure out, okay, how much help do you need? And so we start off living at home independently, and then as we begin to age, we need more and more assistance. And the cost increases as we go down this long-term care journey. So living at home, according to Genworth, and at least according to just kind of my experience of doing this last 16 years, typically it's going to cost you about $1,000 to $3,000 per month if you're buying a couple hours per day, couple times per month. Generally, home care costs are about $20 to $30 per hour. Okay, and so that's where kind of that long-term care journey really starts. And then we might move into independent or assisted living. And the lines between these are starting to gray. They're starting to blur, because initially we had retirement communities and then we had assisted living communities. But the retirement communities got tired of seeing people transition to the assisted living communities. So they started to bring in home care and that type of thing. But here you're probably looking at, on the low end, maybe $2,000 per month to the beginning of assisted living, I would say, is about $5,000 per month. And this is typically like an apartment or hotel type environment with additional services provided. Then you get to assisted living with memory care, which is the high end of assisted living. And now you're looking anywhere from $5,000 to maybe $8,000 per month. So these are places like Arden Courts and other memory care communities. And what we find, at least, is typically people will spend about 1 to 3 years here, 1 to 3 years here, whether it's independent / assisted living. And then the average stay in a nursing home, this is about 2.5 years. And this is kind of hard data from Genworth. Average stay in a nursing home is about 2.5 years. The average cost of a nursing home in Michigan is about $8,000 to $12,000 per month. And we know current statistics say 1 out of 2 people will need nursing home care. And I know, or according to statistics, 3 out of 4 will need some form of long-term care, whether it's home care, assisted living, or nursing home care. Okay. So yeah, the total cost of care, if you look at it fully, maybe 1 to 3 years of needing home care that could run $1,000 to $3,000 a month, 1 to 3 years of needing assisted living, which could run $2,000 to $8,000 a month on the memory care side, and then nursing home care. 1 out of every 2 people will need nursing home care. That's on average is going to run you 2.5 years. Obviously, I've had clients that never set foot in a nursing home. And then I remember a woman came up to me at a workshop and said her mom had been in a nursing home for 19 years. That's certainly not the norm. The average is 2.5 years. And I checked the average for a nursing home room in Michigan as of 2020. And this is just average. But right now we're talking about $9,733. And that's for a nursing home room in Michigan. The average assisted living is $4,200. And the average home care provider, this is actually higher than I typically say, is $4,767. So those are the numbers as of 2020 for Michigan. So home care, it's going to run you $4,700. Assisted living, $4,200 on average, and then a nursing home, $9,733 as of 2020, and that's across the whole state of Michigan. I remember I took a call from an individual earlier this year, and their mom was paying $14,500 a month for the nursing home they were in Michigan. So kind of runs the gamut, and that's why it's important to work with a certified elder attorney. This is what we do: is we help families navigate this long-term care journey. So it's a piece of what we do at Castle Wealth Group, and it's I think this, along with taxes and now probably inflation, are probably the three biggest risks that a lot of families face. How are you going to navigate this elder care journey? So, question: can I replay this session later? Yep. So everything, all of these wisdom webinars will be on our YouTube channel. If you want this specific one and can't find it on our YouTube channel, which is, sometimes I can't find what I'm looking for on YouTube, just send me an email or reply back to the email. And as soon as this is done, I will make sure to send you a link so you can watch it again. Or if you want to send it to anyone else, we certainly appreciate people subscribing and just getting educated on this. And again, I think long-term care costs, we've been banging this drum along with taxes. It's one of the biggest concerns for a lot of the families. And a lot of times it takes seeing a family member go through this before it becomes a concern, but it should be something that's high up on your list of things I need to do to, as I move into retirement and plan for the rest of my life. What are the things I should be concerned about? And it's very easy to put your head in the sand and just pretend it's not an issue, but it certainly is an issue. So, yeah, let me just make sure I answered this question. Yeah, we talked about nursing home. Yeah, total cost of long-term care. It really depends, and it depends on your health. So I have some families who never have to pay any type of long-term care costs, and then I have families that have a loved one diagnosed with dementia, Alzheimer's, Parkinson's, and it's a long road. So it's a little bit different for everyone, but that's why I think it's important to know the averages, and then also just take some thought in planning for it. I'm not saying to run out and get long-term care insurance or anything, but just understand the threat and understand what your answer to that threat is going to be. And really, it breaks into a couple different options. Really, you have, if long-term care is a concern, you have kind of financial / insurance options. And then you have kind of legal options as well. And this is where, of course, our asset protection trusts come into play. With regards to financial insurance options, we're not a big fan of pure traditional long-term care insurance for a variety of reasons. But here you might look at asset-based long-term care options, which we went over before. Cash value life insurance or index universal life that can provide tax-free income, and then a death benefit that could double as long-term care. And then also you have fixed index annuity options with kind of long-term care riders. So there's, again, and we always focus on kind of what are you trying to accomplish? So let's figure out what's your goal, and maybe long-term care planning is a goal. Then let's talk about the strategy. Oops, I can spell. So what's the strategy we want to utilize, and then pick which tools, because all of these are just tools. And unfortunately, I see these tools misused. I had a client come in. We just do their estate planning. We don't do any of their financial or insurance or tax planning work. And they were sold a asset-based long-term care plan that I think it was just completely missing the boat, where it wasn't taking into account the entire planning scenario. So a lot of time, and just taking one step back, we have these different tax buckets. And a lot of times taxes are driving a lot of the discussions right now. And you have non-qualified accounts. These are like your, like your checking, savings. You have tax deferred. This is like IRAs, 401ks. And then you have tax-free like Roth and IUL, cash value life insurance, 529s, et cetera. So most people think at the end of the day, where are taxes going? Taxes have to go up. And so what that means is the first account we should spend money down is the tax deferred, typically followed by the non-qualified. And then the last thing we want to spend is tax-free. So for example, for a majority of our clients, when we're doing some type of asset-based long-term care plan, where we're taking a chunk of money and turning that into a long-term care benefit or a death benefit, where do we want that money to come from? We want it to come first from here, right? And so unfortunately, this is just sold by some insurance guy. They did the asset-based long-term care out of here when they completely missed the boat and had opportunity to pull the money from the IRA. So it's not just about like, all right, I want this tool. It's making sure it fits into the strategy and accomplishes your goals. So that part was a little frustrating, but yeah, so long-term care, big concern. And I think it should be moving forward, especially with longevity. I just met with some clients. A husband was sitting right there and he said his mom passed away at 104. So, and dad passed away at 95. So there's some good genetics there. Here's a question coming in. Considering insurance commissions, complexities of annuities, insurance policies, is Castle Trust cheaper and simpler alternative? So just kind of boiling down the question, should I do a Castle Trust or should I do these? It gets back to what your goals are. Neither is a perfect tool. Like a Castle Trust, even though I think it's pretty darn cool, it's not a perfect tool for everyone, depending on what your situation is. Like even my parents have asset-based long-term care and a Castle Trust. So it's not one or the other. It's all about figuring out what is your goals, figuring out the best strategy, and then the tools. And that's why, again, it's so important where you get your advice from. And this is one of my big frustrations in life. Not that, I don't know, not to toot our own horn, but understand that there's different levels of advice. So at the bottom level, you have vendors. These are people that are just going to sell you something. And these are like your insurance salesmen. They work for a company. Their only purpose is to sell insurance. This is also like the vanguards of the world. Like they're just custodians. They're not giving you advice. And you even have attorneys here, your trust mills, where everyone that walks in gets a trust. And again, that's not our approach at all. So this is like do-it-yourselfers. And I see a lot of, not to pick on the engineers in the world, but they want to do it themselves and think they're saving money, but you just don't know what you don't know. And then you have kind of a step up from there. You have your investment advisors, where at least they owe you a fiduciary duty. Your Edward Jones, your Ameriprizes of the world, but talk to them about taxes. They can't talk to you about taxes. Talk to them about legal structures. They can't talk to you about that. Versus where we try to focus is holistic advice. So if you were to talk to like a vendor and ask them that same question of, should I look at a trust versus annuity? They're going to say, hey, depending on who you talk to an insurance person, they're going to say, go get the insurance. You talk to someone that just does the legal planning, they're going to say, just do the trust. But our approach is different. We first need to take a look at the whole picture and focus first on what your goals are. So these are just tools. It's important to figure out what is the best tool for you. And the answer to that, unfortunately, on this webinar is always going to be, it depends. That's where we sit down and figure out what's best for you. Okay, all right, done on that one. Let me just make sure I don't have any chats. Okay, good. All right, one down. So these first two were just continuations from last week. All right, thanks last week for the advice on daily money managers, trustees, and powers of attorney. One of the causes of complication is in following the advice is following advice about diversity against risk. We have 20 investment accounts with 4 brokers. So let me talk about diversification there. How do you recommend reliable, honest support? FDIC. So there's a lot to unpack here. Ratings for insurers, are there agencies that insure against losses from brokerage and financial advisors? You're a CELA and CFP, they test knowledge, but do they monitor performance or fraud? So this is kind of a follow-up from last week. And the question last week was, as we age, we're maybe not wanting to deal with all the bills and stuff. So what do we do? How do we make sure all this stuff's taken care of? And from a legal structure, this is where we create your rule book of appointing people to take care of things, not necessarily if you're just incapacitated, but if you just want to turn it over to them. And this is really where the financial power of attorney and the trust come into play. And then the question last week was getting to, well, that's a lot of responsibility, like handling day-to-day bills. What other options are there? And there's like people out there like daily money managers or bookkeepers or even CPAs. But really the crux of this question was getting to like, how do you trust these people? And I don't have a perfect answer. It's all going to be about, it's all going to be about just finding someone that you trust, to be honest. And what I would say is the sooner you find someone you trust, the better off you are, especially if there's concerns about aging and dementia, because sometimes that internal trusting compass can get off. And so, again, not to toot our own horn, but that's where a lot of families just feel comfortable with us and trust us. They meet with us, they've attended a webinar, they attend or a workshop, they've attended these, and we develop trust. Unfortunately, there's no magic wands. Like, unfortunately, I just saw something last week where a certified elder law attorney who has like above fiduciary duty, attorney-client privilege, he was in Utah. He was a CELA, which is the top designation you can get for estate planning and elder law. Got charged in U.S. federal court for embezzlement for like 50. I don't know what it was. It was like $20 million. And if you want to Google it, it's like Utah elder law attorney embezzlement or something like that. And so on our listserv, someone sent a note, and then he was immediately kicked off out of the CELA program and everything, and he's going to jail. But there's no designation or anything that's going to say this is a trustworthy person. As a CELA and a certified financial planner, we do owe a fiduciary duty. And if we violate that, we're going to sacrifice our designations. As an attorney, if I embezzle, chances are I'm going to court and I'm not going to be an attorney anymore. But I would say having those designations is better than not, because at least, you know, the person knows exactly what they're doing and they haven't done that or been caught in the past. But at the end of the day, I think it just comes down to trusting your human nature to find someone that you trust in that role. There's no agency that's going to be perfect. There's no designation that's going to be, you're going to find bad apples in every profession. So at the end of the day, it's just trusting the people you work with. Like even ratings for insurance, like, yeah, there's A-rated and B-rated. And if I had a choice, if we're looking at long-term care, I'm going to use an A-rated company, of course. And I think people overestimate like the value of like FDIC insurance. And people have more of that than they actually expect. Because even with that, it's just backed by the federal government. Like, people have questions about the federal government at the end of the day. But I'll tell you, in our 16 years, none of my clients have lost any money from any defaults or anything like that. And one thing I do want to point out is I will say that some people look at diversification. This is something that we have to be careful with. It's like, I'm diversified because I have all my money spread out. First of all, a lot of times if you have like 4 different advisors putting together portfolios and they're not seeing what the other people are doing, that might not really be diversification, because you might have overlap in these different portfolios. And then the other thing I'll share is that, okay, you have 20 different accounts. God forbid you pass away. Like, it's going to be a pain in the butt for the kids to reach out to all and handle all these accounts. I'll tell you, one of the things that we try to do is we try to simplify and take away the complexity at the end of the day. And not only just to allow you to focus on what you want to focus on as you're retiring and aging, but also, God forbid you pass away, now your trustee or beneficiaries have to go to all these different accounts with their death certificates and certificate of trust to close all these different accounts. You know, like one of the visions of why we do what we do, where we put together these legal, financial, kind of tax planning all under one roof, is that now like all this just focuses into one spot. So at the end of the day, you have one-stop shopping. And if you don't trust us, that's fine. Like find someone else. But I'll tell you what, our families appreciate that their loved ones don't have to go to 4 different places and close out 20 different accounts. Yeah, but just because I have a CFP or CELA, does that mean that you can trust me? No, it's just hopefully we do enough to earn your trust. So hopefully that's helpful. I don't have a perfect answer. There's no like supreme governing body to like bless whether someone's not a Bernie Madoff at the end of the day. Like, and that's just unfortunate nature of the industry. There's going to be good apples and bad apples. I would say that typically if you have the higher designations and you put in the work, chances are you're not going to do something to sacrifice that. But there's examples of people that done it, like just last week. Unfortunately, this is the first time I've ever seen it. A CELA got arrested and accused of fraud, which just broke my heart. It puts the whole profession down. So that's where I guess kind of getting back to this concept of it's very easy to be an insurance salesman. You just have to pass a 3-hour test that you can get done within 30 minutes. That basically, if you can fog a mirror, you can become an insurance agent. And so there's a lot of people just selling life insurance and annuities. It's harder to become investment person and fiduciary, and it's harder to do all of that and also become an attorney. So I would look for someone who has more to lose if they were to violate that fiduciary or attorney client privilege. Here's a comment or question. Making use of automatic bill pay by all of your utilities takes quite a load off of the administrative work for elder person's shoulders, and it's at no additional cost. Yep. So that's exactly what we're talking about. Like, if you can set things up as automatic payments, automate as much of it as possible, it's gonna make things easier. And that's really what I'm getting with this. Is like, let's try to simplify versus make things more complex at the end of the day. Because the simpler it is, the easier it is to understand, I think the less chance of fraud there is. You know, like where do people a lot of times get caught up in some of these fraud, like the Bernie Madoffs? It's like, all right, we're going into these like unique investment opportunities and stuff. Like there's more of a chance for fraud there than trying to keep things as simple as possible. And like, that's really what we're trying to do, is we're trying to simplify as much as we can at the end of the day. Yeah, sure. Some of the things we'll do are a little more complex, but we have to have reasons why we do that complexity. All right, we'll keep on going. Oh, here's another one. Not a question, but when my father-in-law died, he had over 20 accounts. My mother-in-law was clueless. So we met with Schwab, and after many days and many hours over a few months, they got us down to 4 accounts all at Schwab. Incredible help for no upfront charges. Yeah. Again, like if you can simplify this as much as possible, I'm a big fan of that. And a lot of times people think diversification is like, all right, I'm going to put 100,000 at this account or this Schwab, $100,000 at TD Ameritrade, $100,000 at Bank of, like you're not diversifying the way you think you should be. Sure, you get more FDIC protection, but I'll tell you, I've seen a lot more undiversified portfolios than I've seen people lose money because they didn't have FDIC coverage. Yeah, so whenever we're setting up estate plans or helping people, we try to consolidate as much as possible. Simplicity is important. Thanks for that comment. All right, I think, yeah, 2 more. We are preparing to refinance our home right now, and it's in a trust. The mortgage company is giving us a hard time with the home being owned by the trust. What are our options? Okay, so I think we've talked about this before. So you have your home, and I'll tell you what, a lot of times when we're doing a revocable living trust, the home stays in your name, and it only goes into the trust upon death. We call this a ladybird deed. And I apologize, we use all of the acronyms. Ladybird deed is named after Lady Bird Johnson. Basically what it is a beneficiary designation. So it's in your name while you're alive, upon death goes into the trust. If this was the case and you try to refinance, no issues whatsoever. It's still in your name. But we see situations where, and we wouldn't do this, but we've seen where the revocable living trust was actually the owner. There's no good reason for that. In fact, there's some downsides to that. But if we are putting together an asset protection trust, a lot of times we will have the home in the trust. And so this is where we run into the issue sometimes. So a couple options. Really, there's two options. Yeah, I'll get to that question in just a second. That's fine. Okay, so with the revocable living trust, the house should not be owned by the revocable trust. So what I would do is I would deed it out and then do a ladybird deed so that upon death, it goes into the trust. And then once you've deeded it out, now you can refinance. So that's straightforward if you have a revocable living trust. Castle trust, you have a choice to make. One, find a different lender. So there are lenders that will lend directly to the trust. Or second, we can do the same thing. Or take it out of the trust, we do the refi, and then we can put it back into the trust. Downside of that is you would, restart that 5-year clock for Medicaid purposes. If we were trying to get qualified for Medicaid. But a lot of times when people are refinancing, they're still pretty healthy and there's no concern of having to go into a nursing home. So I would only be concerned of doing this if there's a concern of going into a nursing home anytime soon. I get the third option, just find other ways. Like not do it. Use some other funds, like pull money out of the IRAs, especially if you think taxes are going up. All right, I'll get to Don, your question in just a second. All right, number 4, and then I have one more question that came in after this. You had mentioned in your last email, and we've seen the news about inflation. What are some big picture things we can do to protect our money, but still try to keep up with inflation? Big thing here, and again, here's the answer. It depends on your situation. But the big thing is just kind of understanding, all right, if we have inflation, and we think there's kind of like 2 different types of, or any investment can have 2 out of 3 characteristics. We can have like growth and liquidity, we can have growth and safety, or we can have liquidity and safety. So with all the concerns of inflation, and one of the big things with inflation is that like Social Security, I think next year is supposed to go up 5.9%. Cost of gas, cost of everything is up, cost of food is up, everyone sees it right now. So the big issue is having money sitting in cash. And if you have a ton of money sitting in cash and inflation's going up 5.9%, what are you earning on that money? Next to nothing. So what we need to do is figure out, okay, what is your emergency fund? What is the money that you need maybe over the next year or 2 years, depending on what the situation is. And then let's get it to growth. And there's lots of different options. So the big thing with inflation is, okay, Social Security is going up 5.9%. What's the cost of everything going up or what's the cost of everything else going up? And if you're only earning 0.5% on what you have sitting in cash, then you can't have money sitting in cash. We call that going broke safely and slowly. So just understand that if you do have money sitting in cash, there are different options. We can have growth and liquidity, we can have growth and safety, and there's even things that we can have that have like a little bit of all of this, of growth, liquidity, and safety, where we're earning anywhere from like 2.5 to 6% rate of return, and it's completely liquid. So it's, again, figuring out what is your goal. If your goal is to, hey, I need to get a better rate of return versus 0 given inflation, let's look at what the different options are. And some of them can be geared towards growth and liquidity, can be growth and safety, or it could be growth with safety and complete liquidity at any time. So Yeah, the big thing is just, okay, we can't have a ton of money sitting in cash. We need to make that money work for us. So it depends. All right, and then another question, and this is almost opening up a can of worms. So Bitcoin, do I think this is a good investment? So as a fiduciary, I can't help you with this, but what I'll say is just kind of give you my thoughts. And this is me just speaking off the cuff. I'm not saying rush out, buy a bunch of Bitcoin. A lot of it's super confusing. But what I'll say is a lot of times in the past, people looked at gold as that kind of alternative to cash and stocks, where if we're not comfortable with how the US dollar is, then what is a good hedge against that? Maybe it's gold. The weird thing is both of those things have no actual value, right? Like, why do we assign a value to cash? We just deal with it and barter based on it. And the same thing with gold. Like, granted, we've used gold for longer. It's like a precious metal, but in reality, and with some of my clients, I say, like, if the world really goes bad, like, what is gold going to get you? I want like ammunition and food. But for a long time, we've said that gold is kind of a hedge against like the decline of the dollar or something like that. But what a lot of people are now doing is kind of moving to the digital world. And this is where, okay, you have this big group of people internationally that have assigned a certain value to like cryptocurrencies like Bitcoin. And it's completely volatile. Like, if you watch the prices, your Bitcoin's valued at 50,000 one day for one Bitcoin, to 20,000 and then 30,000 the next day, and then it's up to 60. So if you're on this webinar and you're anywhere near retirement, I would not put all your money into Bitcoin. But if and I have a like a kind of investing pyramid. I don't have it in front of me, but like a portion of your investment, especially as you get closer to retirement, should be relatively geared towards safety and growth. A portion should be geared towards like growth and maybe more volatility. And then we have this like 0 to 10%, where that's people are investing in real estate and business opportunities. And maybe if you want to put a portion to that, to Bitcoin, that's great. I certainly wouldn't put everything in there. Like, do I personally have some Bitcoin? Yeah. But again, I don't think it should be a big part of anyone's portfolio who is on this call. So that's my Bitcoin thesis. But yeah, I see, if you were to put a gun to my head, I see kind of Bitcoin being the next form of gold. If you're not comfortable with where the dollar is at and what's going on, that might be something that you look towards as a hedge. One of the problems I always had with gold, like especially if you have like physical gold, is okay, that's great, you can buy it, but trying to unload it, like there's transaction costs, and that's something where Bitcoin you don't necessarily have that. Like, there's a lot of places that take Bitcoin versus I had a client who knew someone who was very wealthy and had like a whole like basement filled with gold bars and was willing to sell it to my client for like 50 cents on the dollar. Like, I understand, like, sure, you can buy it for one amount, it says it's valued, but trying to unload it is a little more difficult. So I think Bitcoin's interesting. I think it's going to be maybe an alternative gold, but I certainly wouldn't put all my eggs in that basket. So yeah. All right. Any other questions? Going once, going twice. All right. Well, if I don't talk to you, have a great holiday. We'll be on next Wednesday. If you do have questions, feel free to send them in. I love answering these questions live. So with that, I appreciate everyone. Make it a great week. Talk to you next week. And feel free to share this